All right, let's jump right into this explainer and run the real math on whether real estate or index funds will actually make you more money over a 20-year timeline. We have all seen the flashy thumbnails, right? And we've definitely heard the intense arguments at dinner parties. You've got one person who completely swears by rental properties and another who insists the stock market is literally the only way to go. But honestly, rarely does anyone sit down and actually map out the true comprehensive cost in dollars, in time, and in sheer stress over 2 full decades. Well, today we are going to do exactly that.
To make this super clear for us, we are going to follow two identical investors. Meet Jake, who chooses to go all in on a rental property, and Marcus, who decides to put his money into broad market index funds. Now, both of these guys are absolutely convinced they've made the smarter choice. But as you'll see, the numbers tell a vastly different story depending on what you actually bother to count. We are going to track them side by side to see who is really coming out on top. And to keep this a completely fair fight, both Jake and Marcus are starting out with exactly $50,000 saved up. They both earn $55,000 a year, they are the exact same age, and they live in the exact same city. We are making this a perfectly level playing field. Literally, the only difference between them is what they decide to do with that 50 grand. So let's look at day one. Jake takes his $50,000 and uses it as a 20% down payment on a modest $250,000 rental property. He takes out a 7% mortgage, which makes his monthly payment about $1,330, and he instantly finds a tenant willing to pay him $1,800 a month. Now, on paper, that is $470 of pure profit every single month. So on day one, Jake is feeling like an absolute financial genius, standing there with his tangible property. Marcus, on the other hand, he drops his 50 grand into a total stock market index fund and sets up an automatic contribution of $300 a month. No tenants, no keys. While Jake has this great, exciting story to tell his friends, Marcus just has a really boring confirmation email. In terms of how it feels right out of the gate, it's not even close. But as we know, feelings and math are two very different things. So let's fast forward a bit along our 20-year timeline and stop at year 3 to see what's actually happening beneath the surface. Now, what's really fascinating here is how that $1,800 rent check gets instantly devoured. Everyone loves to brag about their top-line rent, but just look at this breakdown. The mortgage eats up $1,330 right off the bat. Then, property taxes and insurance swallow another $375 a month. Suddenly, what's left over is looking extremely thin, completely destroying that illusion of pure profit that Jake was so incredibly excited about on day one. Because by year 3, the hidden costs have hit, and they've hit hard. Jake has had to shell out $1,200 for a dead water heater and another $2,800 to fix a leaking roof. On top of that, he had to deal with 1 month of vacancy. And a vacancy essentially means paying a full mortgage payment with absolutely zero income to cover it, plus $600 in listing fees just to find a new tenant. And because he's managing it himself to save money, he is the one taking phone calls about plunge toilets at 10 p.m. So his actual net cash flow over those 3 years, it isn't the $17,000 he confidently projected. It's a fraction of that. It's somewhere between $2,000 and $4,000 total. He is basically working an unpaid, high-stress, part-time job. Meanwhile, Marcus is experiencing a totally different year 3. With his initial 50 grand, his $300 monthly contributions, and an average historical return of around 10%, his portfolio has quietly grown to about $76,000. But the absolutely crucial point here is this. He has spent exactly 0 hours managing it. 0 phone calls, 0 weekend emergencies. He literally just didn't touch it. But hold on, we absolutely cannot count Jake out just yet. Jake is still building real wealth here because of a powerful concept called leverage. He used his initial $50,000 to control a much larger $250,000 asset. So even though his cash flow is mostly eaten up by expenses, that property is slowly appreciating at 3 to 4% a year. And his tenant is the one actually paying down the mortgage. His equity is growing nicely, and that is a massive advantage that stock investors like Marcus just can't easily replicate. On the flip side of that coin, Marcus is beginning to experience the magic of compound growth. This is where the gains on his original investment actually start doing the heavy lifting for him. The gains on his gains are now generating more new wealth each year than his actual monthly contributions. Compounding is pretty boring for the first 5 years, sure, but it becomes astonishing over the next 15. All right, let's jump back to our timeline and see how this all builds up as we hit the 10-year mark. This is usually the point where these investments truly start to mature. And at year 10, the math is honestly pretty shocking. Jake's property has definitely appreciated, but after you subtract all those out-of-pocket costs for taxes, repairs, and vacancies, his total equity is sitting right around $170,000 to $184,000. And Marcus, with his consistent contributions and pure compound growth, he has a portfolio sitting between $165,000 and $180,000. Their net worth is in the exact same ballpark. And this right here brilliantly illustrates the true hidden costs of their distinct choices. Yes, they have very similar wealth, but look at the toll it took to get there. Jake spent thousands of dollars out of his own pocket. He still holds over $166,000 in debt, and he has spent hundreds of hours stressing over one single asset in one single zip code. Marcus? He spent exactly 0 weekends fixing anything. He carries 0 debt. He's diversified across thousands of global companies, and he has slept perfectly fine every single night. For us, this really highlights that the cost of an investment isn't just measured in dollars, is it? It's measured in your time and your peace of mind. Now, let's fast forward to the grand finale, the final tally at year 20. This is where the story fully separates in terms of how that wealth was actually acquired over a lifetime. Astonishingly, after 2 full decades of these vastly different strategies, both investors end up with a net worth squarely between $400,000 and $500,000. Jake's mortgage is nearly paid off by now, and he's collected rent for 20 years, but he has also definitely funded at least one major renovation. Marcus's portfolio, on the other hand, is roughly 75% pure compound growth from his original investments. The numbers are practically identical, but Jake essentially worked a second job for 20 years to reach this number. He dealt with illiquidity, terrible tenants, and constant maintenance. Marcus literally just waited. He had freedom and liquidity. It really proves that a similar financial destination can be reached through entirely different life experiences. Now, if we just stopped there and only looked at the downsides of real estate, we wouldn't be doing a fair explainer. And frankly, that's exactly what so many influencers do. So let's flip the script. Let's look at the brutal risks that Marcus faces in the stock market, because his path wasn't perfectly smooth either. Because let me tell you, stock market volatility is absolutely gut-wrenching. Imagine being Marcus in 2008 when the market just fell off a cliff, dropping roughly 37%, or in March 2020 when it plummeted 34% in a single month. Watching a $150,000 portfolio suddenly drop to $95,000 isn't just some abstract number on a screen. It induces sheer panic. And the data is crystal clear on this. This kind of volatility causes most retail investors to panic sell, locking in their losses at the absolute worst possible time. Plus, Marcus is missing out on some incredible wealth-building tools that Jake gets to use. For one, index funds do not mail you a monthly rent check to spend. A total market fund may yield a tiny 1.5 to 2% in dividends. Marcus also has 0 leverage. He only controls exactly what he puts in, whereas Jake leveraged 5 to 1. And Marcus completely misses out on massive, totally legal tax shelters, like property depreciation. This allows real estate investors to actually deduct the theoretical decline of their building from their taxable income, even while the property is going up in value. It's crazy. And because of those advantages, real estate absolutely wins in a few very specific, identifiable situations. For example, if you are in a market with a strong rent-to-price ratio, say 0.8% to 1% of the purchase price from day one, well then the cash flow math really works. If you treat it as a strict, systematized business, or utilize incredible strategies like house hacking to reduce your own living expenses to 0, real estate is simply unmatched. And if you use 1031 exchanges to endlessly defer your capital gains taxes, you can build massive, tax-free wealth that stock investors simply cannot replicate unless they lock their money away in strict retirement accounts. So, looking at this side by side in our ultimate 20-year summary, it becomes super clear that neither path is objectively better in a vacuum. They are just entirely different financial vehicles. Real estate isn't a bad investment at all. It's just a highly misunderstood one that requires serious effort and active management. Index funds, meanwhile, offer passive compounding and high liquidity, but they demand an absolute iron stomach for volatility. They come with completely different price tags in terms of your time, your stress levels, and your personal risk tolerance. As our source material so brilliantly summarizes, the ultimate mistake isn't choosing stocks, and it isn't choosing real estate. The real trap? It's making a massive, multi-decade financial commitment based on a catchy podcast clip or something your uncle confidently said at Thanksgiving without ever actually mapping out the true hidden costs for your specific life situation. So what should you take away from all this? The next time someone confidently tells you that real estate always wins or the stock market always wins, don't just nod along. Think about the data we've covered today. Look them in the eye and leave them with this one essential question. Did you include everything? Because in the world of long-term wealth, the answer that includes the hidden costs is literally the only answer that matters.